So in our last panel, we alluded to it briefly. Why venture capital? There's so many times where I have entrepreneurs that will come up and be like, "Oh, I just need to raise $500,000 to get my idea off the ground." And I think there's a big misconception around what venture capital is and what it does, because it honestly is a tool. I'm not going to spoil the panel, but just as a quick thought, a lot of times venture capital is honestly, it is pouring gasoline on a fire. A lot of people don't understand that. You generally need to have a fire built or have built a fire before to be able to get venture capital, to be able to show traction and take it to that next level. If there isn't a fire, if there isn't anything burning, then there's nothing to amplify with venture capital money. And so that's one of the reasons that we have this panel. We're very fortunate to have some very great speakers up here. First, I'd love to introduce Kiyan from Mucker Capital. Rick Smith from CrossCut. Where is Rick? He might be outside. Hey, Rick. Yipeng from Embark Ventures. Christine from IX Investments. Christine, there you are. Hey! The panel is already prepared. They're like literally right in front of me. And then Danny is jumping on board as well. Danny, who runs Atom Factory and Cross Culture. Yeah, one more round of applause for our panelists. Is this thing on? Yeah, that's on. Awesome, guys. Well, welcome to the panel Why Venture Capital. Quick intros. Today I have with me Rick Smith at CrossCut, Yipeng Zhao at Embark, Christine Harada at IX Investments, Drew Leahy at Hawke Media, and Danny Brown at Atom Factory. My name is Kiyan Yazdi. I'm an investor at Mucker Capital. We are an early stage investment firm in Santa Monica. I think to start, it would be helpful to give a quick intro and background about yourselves and your firms. Rick, do you want to start?
Sure. Is this on? Yeah. So Rick Smith, CrossCut Ventures. I helped co-found CrossCut 10 years ago. Now going on 11 years. We're an early stage venture capital fund based in Los Angeles. We have around $220 million under management. Our current fund, we're investing, it's our fourth fund. We're investing largely in seed investments, which for us is maybe half of a $2 to $4 million raise that an early stage company is doing. We are relatively industry agnostic within tech, which is pretty broad. We definitely invest in entrepreneurs first and companies second. We've had several successes over the 10 years. A lot of those in consumer space, but we're also investing a fair amount in enterprise software, gaming, and again, across the board. So happy to be here today. Everyone's spending their Sunday. I do know that the Patriots score, I won't say it, they went to recording the game. We do know what the Rams did last night. I don't know what the Patriots are going to do today. Hope they don't win.
My name is Yipeng Zhao, a partner at Embark Ventures. We're a $45 million seed fund based in Santa Monica. It's our very first fund. We closed the fund about 2 years ago. We write check from $250K up to $2 million. The thesis we have is around deep technology. We want to invest in companies that have some defensible technology around the business. We have a couple sectors that we are spending some time on. First one is cybersecurity and cloud infrastructure. Another one is automation, so both robotics and also AI machine learning, so software level of automation. And so for me, I spend a lot of time in materials, especially new material discoveries and new material platforms, and also a little bit about biotech, especially biomaterials and diagnosis platforms. Yeah.
Christine Harada, the president of IX Investments. We're actually a little bit different than probably most people on stage here. We're a permanently capitalized holding company. We've got a venture arm. And we focus on impact investing, and that is, we want to make sure that we're targeting those companies that are profiting for purpose, and we're not sacrificing any returns just because it's impact. That is our mission, that is our thesis, and we're sticking to it.
Hi, I'm Drew Leahy from Hawke Ventures. We're partnered up with Hawke Media, which is the company that Sean was mentioning on stage. Hawke Ventures is an early stage investment fund that focuses on helping grow companies in the consumer and technology that powers consumer space. Usually that's B2B SaaS. And we started about 3 years ago with Eric Huberman, who's the CEO of Hawke Media's Angel Investments, and we've come on to raise a venture capital fund and now invest in companies.
Hey everyone, I'm Danny Brown. I'm Chief of Staff over at Atom Factory and CrossCut Ventures. We are also a little bit different probably from the rest of the panel in the sense that Atom Factory has been in the music industry as its core focus for the last 10 years. Out of that, we developed an angel fund as well as raised a traditional venture fund called CrossCulture, and both share a similar thesis, kind of shaping the future of consumer and identifying entrepreneurs that are really doing a great job at sort of picking up on shifting global trends, and that will grow and scale over the next sort of decade or so as we really partner up with them.
Awesome. Well, great. Thanks for the introductions. I think to start the conversation, founders and investors alike are always trying to cut the learning curve for founders. So on that topic, what is the biggest mistake you see founders making across the board? Whoever wants to begin.
Well, I'll just jump in. I think one of the things that we've seen over time, when you're raising capital, it's very difficult. These are good times to raise capital. It's still really hard to raise capital, right? It's still really hard. And so there's a little bit of a courtship that has to go on to get an investor to finally, several investors you have to talk to, 100, find one, whatever. I think embracing the VC as a partner, it sounds kind of simple, but I find a lot of entrepreneurs, especially maybe less experienced ones, have a harder time doing that maybe as quickly as they should. Because once we're in, we're your partner, right? We're on your side. We want to help you grow the company. And at times, there's a little bit of a standoffishness. And frankly, at the end of the day, we're all in it together. We're trying to help you succeed. It's certainly incumbent upon us to try to get the entrepreneur to feel more comfortable, that they can share their innermost, concerns, and we want to be that call that they make at 11 at night, 2 in the morning, whatever, to say, hey, I have a problem. One of the things I started to do more recently, get away from the numbers a little bit, and more on just, how are you doing? I think that question on the CEO is a very lonely job. It's like, head coach of a football team or something. It seems glamorous at times, but there's not a lot of people you can turn to. And hopefully your VC can be one of those people to turn to. It just sometimes takes a while to kind of embrace that.
So since I think our panel is called Why Venture Capital, I think the biggest mistake I think is first, people raise VC money where they actually not a good fit. I think that's a very big mistake. A lot of entrepreneurs made. I think another one will be just cash and
What makes it not a good fit?
I think that venture capital is only for, this is actually a very good article just published by New York Times like this Friday or something, last Friday. So venture capital is only for 1% of the entrepreneurs, right? So it's for hyper growth, swing for the fence type of business. Right? A lot of companies, you actually don't really good fit for venture capital funding, but there's a lot of other funding, right? If you actually spend too much time on the funding source that are actually not a good fit, you drag down your current cash flow, you drag down a lot of stuff, right? So just don't waste time on venture capital if your business is not really a good fit after venture funding. And we can talk more about what's really good for venture capital, what's not. I think another one is definitely company culture, right? So I think as a CEO, one of the most important things you should manage is company culture, right? So just embrace that, it's a very lonely job in a sense of you have to make other people happy and make the company have a good culture. But you are not necessarily the happiest person on the company. So most companies fail. A lot of them have bad cultures, and how to manage the culture for the company is really important, especially when you hit the growth curve and become a bigger company. Yeah.
I've also seen, and I've done this myself, so when I went out to raise money for my own company, I overvalued my raise, and it was really hard for me to raise money because in my head I was like, this is what I'm worth, this is what we're doing, this is the market, we're going to crush it, yada, yada, yada. And then I wasn't able to raise enough money to close the round, and I had a lot of investors telling me, man, I really like your company, but if your cap was lower, like I would want to get involved with you guys. And we were like, no, like we're going to do it here. And that was just a huge mistake. It was naivete. It was not listening. There was a lot of things. And so that's something you should be really sensitive to is when you go out and raise money is understanding what am I valuing this round at, which is really early stage partners. It's people who want to help you and ask you, how are you doing, you know? And that's worth more than a couple extra points for me if I'm an entrepreneur that wants to raise capital. So your understanding of what that partnership looks like and the value that comes from that, and don't overvalue yourself. I see that really frequently, especially in the last 6 months.
In our case, I think, you know, especially given that we're much more involved in the impact side of things, there's a lot of great passion, as is the case with many entrepreneurs. There's a lot more social impact type passion as a real mission, et cetera, which is great. I think a lot of entrepreneurs firmly believe in that passion, and that passion alone can help sell the story. The reality is, you know, when the investors come in, we double click, we triple click, we want to look into the numbers, we want to understand what are the metrics. Prashant's talk earlier today, how, no joke, are you actually going to be bringing in the revenue? How do you plan on executing the growth? What other resources do you guys have? Right? A great company is a great mosaic of a team. It's a composite. It is not just you. So what are the other colors of the mosaic tiles, if you will, that you need to bring along with you? Make sure that you're highlighting that message to your investors.
I think that's a great point. One of the biggest things that I feel like I've been noticing more and more especially is really making sure the founders understand what's happening after the fundraise and how they plan on using the capital. I think there's a lot of emphasis put on the fundraising process itself, and you get kind of caught up in the pressure and, you know, the do or die scenario. But it's really, when you get down to it, when that check comes in and all the wires close and you're good to go, what are those next key steps? Like, have the hires in mind, have the operational processes in mind, just being really prepared to kind of execute the product, and kind of making that mind shift back into running the company itself.
Great. And so moving on to, or building on to the direction that Yipeng made, you know, there are a lot of different resources and strategies to grow, start, and I guess raise a company. Why venture capital as a resource?
I don't know to talk to that. That presentation you just saw from Sean, everything that he just went through, imagine talking to an investor and then I ask you those questions too. We help companies, and this isn't just me marketing myself, but we help companies grow in consumer with all those metrics right there. If you're investing in space age technology, you might be, you know, have a really good access to rare minerals, and like I can only give that if I have an investor who can get me to those places. So, in my opinion, you're interviewing the investor just as much as they're interviewing you. It's what are you going to bring to the table other than like a couple introductions or something that you know, what is the material benefit that you bring to my company? And so I think that needs to be a lot of alignment between what you're raising money for and what you need in the next 6 to 12 to 24 months to what the VC that you're talking to is able to bring to the table for you. So for us, it's marketing, it's growth, it's understanding the metrics, it's the KPIs, it's all those little things that I can literally go in and start tweaking with a little wrench. For other companies, it might be different based on what their value is that they bring to the table.
Yeah, I think Luke has used the analogy of it's like dumping gasoline on a fire. And the thing is that you want to take money that will really work for you and really help you grow and kind of, for lack of a better word, continue to burn and maybe burn a bigger, brighter flame. So it's really thinking about how you're getting into this deal for probably, you know, at your early stages for the better part of a decade. And it's what do I really need, and how am I really making sure I'm getting that versus just a check that someone will come back in for a return in a decade.
Well, I think I have a very similar view, but also different view on this. I would say venture capital is very important in playing a role in your company, both for helpness, operation, give suggestions, and also introductions we make, help growth, all that stuff. I would say that I think just basically echo on Rick's point. Venture partner is really your partner versus your a guidance operator, right? So it's more like do you think this is a fit in terms of culture, in terms of how we work together, versus this VC makes 10 introductions, another VC makes 12 introductions. So I'm going with the VC who can make 12 introductions, right? It's not that case, right? It's not a quantitative help that VC will give you. It's more like the chemistry type of thing. It's really an art to find your perfect VC fit, right? So I think for in that case, I would suggest not only looking at the on paper what the VC brings you, but also actually spend time. Send some messages. Ask how are you doing, stuff like this, right? Just chit chat and see if this is a good fit in terms of chemistry. I mean, you work together for like 10 years, right? It's actually like a date. It's like a marriage, right? And sometimes you spend more time.
Longer than the average marriage.
Yeah. And you cannot get divorced. That's the worst part.
At least the happy years.
Yeah.
Longer.
And you cannot get divorced. I mean, once you sign the FTA, like you're in for 10 years, right? Like it sucks, but that's the thing, right? So really spend time doing diligence on how the VC actually work with you versus how the introduction they can make, right? So you will figure that out. All that other stuff you will figure that out. And another thing is, I want to say is VC is really a tricky money, right? It's a jet fuel. It's not even gas, it's jet fuel, right? So you have to have a jet to get jet fuel. You can't put a jet in a Honda, right? So I mean, you have to be able to sustain the requirement of venture capital will give you after the investment. So a lot of time, you will hate the VC because you are not really in alignment at the time of fundraising, right? So really understand the requirement of VC funding is really important.
Yeah, actually, that's a good point. I think in understanding how VCs operate, I think is important too, right? Especially early stage, we're wrong 8 out of 10 times. I mean, we see 4,000 deals a year. We meet 400, 50%. We do 10 deals a year, whatever, and we're still wrong 8 out of 10 times. So, and we're, I think, pretty good at what we do. So I think understanding that. And then understanding that any company that we invest in has to make up for all those zeros. Because we don't really get paid until we make up for all the zeros, or ones, 1x, 2x. And then, then we'll eventually take 20% of the upside. We've got to pay back all these losses. So we're looking for things that are jets. That's a great analogy. We have to have a jet, right? And so, we're one of the few people that will give you money, giving an entrepreneur money, and actually say, you're going to lose money. Like, we're going to give you the right to lose money. Most businesses don't have that. If you start a restaurant here at USC, you don't have the right to continue to lose money. You go out of business. We give you the runway to actually get that jet off the ground. We'll help you. We'll clear the runway. We'll put fuel in it. But still, most of the time, the jet doesn't get off the ground, or it hits the trees on the way up and get some exit, but not a great one, right? So VCs are in the business of giving you that leeway and runway, but we have high expectations. We want to make 10x or more in every dollar we put out, and that's really hard to do. And so you got to have the right. It's got to be a big market or a growing market. You have to have something that, if you succeed, can be big. I'd say 90%. I'm going to stop talking. 90% of the companies we see are could be good companies, but not necessarily jets, right? And so that's an important, I guess, thing to think about. Is it whether VC is important or not for your company? But if you need hyper growth, you need to grow faster, and you're in an industry or a company that's going to have other people come at you, and you want to compete, and you got to win, and they're going to. If you don't move fast, someone else is going to come in. You probably need venture capital money.
I think you also, back to an earlier point that was made around being honest with yourself. I think it takes a lot of self-awareness, both about yourself as an entrepreneur, a lot of self-awareness about the strengths and weaknesses of your team, as well as the strengths and weaknesses of your business, right? You really got to be very honest and very cold-hearted, objective about where you need help, and be very specific about that. Let's face it, if you have a paper airplane, dousing it with lighter fluid or jet fuel is a very, very bad idea, right? So how do you make sure that your plane actually flies? And candidly, is the business a right fit for this particular industry? Case in point, 15 years ago, clean tech was a big thing. We all want to invest in renewable energy, blah, blah, blah. The VC industry took a bloodbath. It was a complete bloodbath for the industry because it wasn't the right fit for the kind of business that it is. So think long and hard, have a lot of exploratory conversations and be open about that with VCs. Like, hey, I want to make sure that this is the right fit, not just that we're a right fit, but also that we're a right fit for this VC category as a whole.
Yeah, the only other thing that I would add to that is one of the benefits of venture capital to a founder in a business should be how can they complement your business, right? So what voids or weaknesses does the business have that your investor could at least temporarily fill, whether that's operating experience or let's say you have great technology but you're unfamiliar with go-to-market, maybe they have an expertise with that. So really looking for a partner who can act and kind of fill where your weaknesses are. Okay, great. And so building on that, how often do you guys come across founders and companies who are looking to raise venture capital at the wrong times? And what would be the right time?
So I'll start. I don't think there's, I think there's right time and wrong time. But I would say, I think it's more around, your plans, right? Each company is different. It's hard to say like, that's the right time, that's the wrong time. Every company is different, and different companies have different schedule of how to spend the money, how to need money. I would say for earlier stage, for pre-seed or seed, the timing is for getting started, right? That's the time. For more growth stage venture capital, I would say it's where the economics is proven, and you can know each money you spend, you got more money out. Right? That's where you actually have the feel, right? So I would say the metric is proven. You should use more money, right? But at the earlier stage, it really depends on do you really need money to get started. Right? Some founders can't really self-fund it, right? So they have to raise some money to get it started. And for some companies, it's really about metrics and about how they grow, what's the plan for them.
Yeah, for us, we seriously look at companies to invest in that are doing 20 to 100K in monthly revenue. So if I get a deck that comes across my desk and they haven't launched yet, and they have this super cool idea for a new cooktop, and they have great partners and all these things, but like they don't have any revenue, I'm like, this is really cool. Keep me updated. Would love to see how I can help you as it goes along, but good luck, right? So for me, I'm just looking at companies that to keep using that metaphor, the pouring the gasoline on the fire, understanding what the marketing metrics are. So I think I coach entrepreneurs to bootstrap as long as humanly possible so that your brain and your team has the best idea of what's happening with your company and what the growth looks like. And so obviously I work in a very specific sector, but I really want to see that companies and entrepreneurs have spent a ton of time on their business and understand as much information about their customer as possible. I know so many companies who started off with an idea of who their customer was, launched, it was the 180-degree opposite of that, and then I talked to them a year later, and they're like, oh man, I'm so glad I didn't take money then because everything is different. And I was like, okay, yeah, that's kind of what I was anticipating. So just that timing is really important. You need to be really confident in your business.
Drew, let me ask you a slight tangent. You say, come back to me at some point. How many companies do you say that to, and how many companies of that you mean?
What's that?
Meaning, no, but part of it is, speaking VC talk, understanding VCs is hard for me. I've been doing this 22 years. And so passing on companies, sometimes it really depends on the mood I'm in. Oh, you're too early, or you're too late, you're too tall, you're too short, right? It's like, get me out of this, I just have to move on to my next company, and other times I'm more thoughtful. But I just told someone today, I like the company, but I do want to stay in touch with you, I meant it, right? And I mean it most of the time, but sometimes, and part of this is, how do you say, what's the right way that entrepreneurs can, that's a good question, but understanding VC speak is important for,
that's right.
And so when you say come back to me, most of the time I actually want to see how you do it.
Yeah, what I really mean is like
Mark Schuster for a while.
Yeah, add me to your list of people that when you say, hey, like here's what I did this quarter and it was awesome, or hey, here's this partner I just added. Like add me to that list of, because it takes me 30 seconds to get an email that goes, oh, this actually is starting to come together, versus okay, this isn't the still quite isn't together. So it's keep me in the loop with the good news. When I say come back to me, I really mean, email me in every 60 days and like let me know what's going on, because it doesn't take me much to look at.
And email's the right way, boom, don't expect a response. Yes, ma'am.
I can build on that, especially for people of color, for women, right? We really want to, at least I'm a big firm believer in diversifying entrepreneur base, all of the good jazz. I think that's especially key because frequently we, as a non-white, non-dude, we frequently don't fit a mold, right? And it's just a slightly different product, and sometimes it takes multiple times for people to take a look at the product and make sure that we're starting to get comfortable with the ideas. So, back to the dating and marriage kind of method, idea or analogy, if you will. It's a little bit like dating. Like, hey man, how you doing? Let me tell you about my business. You're actually a little too early stage, honey. Please keep in touch. Like, okay, great. Let's not take that as a rejection. Let's also not like completely pester the guy every 30 days or whatever. But maybe on a quarterly basis, like, hey, I just want to check in, just want to share with you. Here's what's going on. Da da da. And eventually along the way, you may either A, get helpful tidbits of advice from that particular VC that you may or may not have been pursuing. B, maybe perhaps a useful introduction, like, you know what, you're not a fit for us, actually at this point, because we're changing direction, but you guys want to go talk to Yipeng. Like, their group is going to be fantastic for you when you put in an intro, right? So continuing to plant the seeds and building out your network of investors, I think, is super key for your success.
And we also, us as VCs on stage, we have a really long time horizon for the work that we do. Our fund is a 10-year fund, and we plan on raising other funds. And so an entrepreneur that shows me how he communicates and gives me good news, I'm happy to maybe forward something to somebody that I know that says, hey, like, I know this isn't what I do, but like, this guy's been, pestering me for the last 6 months, and I like them, and it's up your alley. And I'm happy to do that, because in 4 or 5 years, that guy might be successful with that company, or might wind it down, might start another company, might do something that's more interesting to me. And like those connections kind of add up over time. I've been doing this I've been an entrepreneur for 12 years now. There's people that I met 10 years ago that are now back in my sphere supporting me and or working with me, because it's just such a long time period. And it's something to keep in mind that like today might not be the day, but 6 months or 6 years might be the day.
Okay, great. So shifting gears a little bit and getting into questions that are more firm for investor specific. What makes you different as an individual or speaking on behalf of your firm from other investors?
Awesome, I'll take a jump. It sounds maybe a little cheesy, but I would say for us specifically, it really is our team. And what I mean by that is kind of just our collective background and experiences across multiple industries, whether that be 10 years of traditional VC experience or 25 years in the music industry, or running a few startups, or immigrating from other countries, or not being a straight white male, no offense to some of our wonderful panelists. But it is very much so about not fitting a mold in our personal experiences that give us perspectives to sort of empathize with, sympathize with, and sort of believe in and really understand certain products geared for different audiences.
For us, I'd say we very much focus on impact, not just like from a financial perspective, but triple bottom line, social, economic, societal, environmental, etc. I think, it's a lot like, for many of you, you probably went to fantastic universities. You're all probably smart enough to have gone to any number of really good schools. But you ended up at your university because that was the best fit for you, to build on your point that you're smart enough, you're good enough, you're talented enough to be able to make it with many entrepreneurs, or many venture capitalists, sorry about that. Want to find the people that you love, that you want to work with, because dude, you are stuck with these people for 5 to 7 years.
A couple of things I think we can offer. I think first, both two partners of our firm are deep tech researchers before. So we understand deep tech very well, and we have empathy for researchers that are recognizing their ideas and their research. So, and we have an extremely long investment horizon, longer than typical VC as well, actually. So just because we understand, deep tech or typically tech transfer takes longer than a lot of other companies. So we have I guess more patient than a lot of VCs. So that's one thing. Another thing is, so we focus on sort of cross-border connections. So we have deep connection in Asia, especially in China and Hong Kong and Korea. So we know Huawei, Lenovo, and all the other big Chinese corporations, Tencent, Baidu, can make introduction too. And we also have some of the top tier companies on the LP in our fund. Some are very deep tech, telecom companies, satellite companies in Asia, or in general Asian countries. So that's something we can provide that a lot of other funds cannot provide. Obviously, that's optional, not a requirement. If you don't really need any of Asian connection, that's fine. I don't think that's a very interesting value we can provide. So yeah.
I've talked, I feel like, a bunch about what we do, but so Hawke Ventures is 4 partners. It's myself. I'm a marketing and growth operator. Like, that's the way that I think about investing. Is like, how do I roll my hands up and roll my sleeves up, get in, and help you grow 20% month over month. Like, that is my focus, and I try to do that for the next several years, right? And then my 2 partners, Eric and Tony, they're the owners of Hawke Media, which is a growth marketing consultancy in Santa Monica. And we help companies grow in our business, and we help companies grow in our venture capital business as well. So we have a ton of experience and a ton of data and a lot of just understanding of what is happening on a day-to-day basis in the marketing world. And so we bring that expertise to our investment deals, whether it's clients to a technology company or marketing expertise to a consumer company. So that's what we laser focus on. And then we have another member of our team, Paige Craig, who recently joined us, who's an exquisite investor and entrepreneur, also has a very extreme operations focus. So we really focus on how we grow companies month over month. That's why we want to get involved with our investments.
Yeah, I would say for CrossCut, we got 4 managing directors with collectively about 60 years of experience in venture capital. We've seen a lot. I've been through 2 or 3 economic cycles. They are not pretty. There's some things you can do to help get yourself through those cycles and prepare now. And we have a vast network. We've backed about 95 companies in Los Angeles. That's probably 200 or 300 founders we backed. And we've always, I think, developed a reputation for being very entrepreneurially friendly, and take a very long-term view, as others have said, of how we approach investment.
Great. And so, what do you guys all individually think your founders or portfolio companies would say about you if you were not in the room or not listening?
I think they say pretty nice things about me.
As a person or as a...
Both.
I'm kidding.
I think both. No, I think, again, I've grown several companies myself now. And so when I come to the table, I literally join somebody's team, like a chief marketing officer, like a growth officer, and I bring all of our relationships, including mine and my partners. And so I'm just all in. What are the things that you need for me to help you? And so I think I've been really helpful with that. In terms of hey, I have this problem, and then I go kind of help them solve it and come back. And so, I like, Rick was saying, being that call at 11 p.m. or 2 a.m. in the morning, I very much pride myself on being able to be honest with each other in these deals so that we can help the company grow collectively. I'm a huge fan of radical honesty, and I believe it's Kim Scott wrote the book, Radical Honesty, but fantastic book on understanding how to communicate with folks. And so I try to bring that approach to our founders.
Yeah, I want to echo that. I really hope that our portfolio companies tell other people that they're super comfortable with us. I'm a really big believer that it shouldn't feel like you're going to the principal's office when you're giving your investors an update. We really make a concerted effort, especially considering, a lot of us on this panel, it seems like, are really focused on really kind of just being in a marriage, more or less, with our portfolio companies for the better part of, 10 years. And really just having that open and honest communication and, really just demonstrating and showing that we're willing to carve out that time for our portfolio is really important, whether that be those texts or calls at 11 p.m. or it be, basically living in our office. We've had companies do that, and that's part of that relationship and that honesty and that bridge building to kind of really get you where you're going.
I would hope that our portfolio companies see us as a real coach. Sometimes it's not pleasant to work with a coach. It's a lot like if you're working with a personal trainer at the gym and she's just making you do all sorts of ungodly conditioning and it really sucks at 6 o'clock in the morning. But in the end, you've gotten a lot stronger, you've lost a lot of great weight, you look fantastic, and your health is fantastic, right? So, we try to strike the right balance between telling you, to your guys' point about being very honest with you, here are the things that we need to do, and then pairing that with very constructive advice on here are the specific next steps. Let's talk next 3 months. This is what we want to see you guys deliver. Here are the deadlines and milestones and deliverables, etc. that we think that you guys can and should be able to deliver.
Yeah, I'll just say, we actually know what they say because we survey them once or twice a year, our founders, and we pay attention to the results and we try to respond to them. We've actually hired a head of platform at CrossCut that is one of his main duties is just to make sure our companies are getting what they need. I think we do a good job with the big stuff. We've got to hire a VP, or we're going to sell the company, or raise some capital. But it's all the other stuff that's the other 90% of entrepreneurs' worries that we want to be more helpful on as well. So that was one of the things that came out in one of the surveys is, how can we be even more helpful to our companies?
Great. And so, moving on to our last couple questions. How do you help successfully manage or navigate major or large co-founder conflicts that may occur within your portfolio companies or have occurred historically?
It never happens. I don't know.
Yeah, I understand this question. Okay.
So I've been through a few of these. I will say setting it up right at the beginning is a key. And one of the interesting things, I don't know the experience level of most people in the audience or how many entrepreneurs or venture capitalists, but one of the typical terms in all of our deals would be the founder, regardless how long he or she has been in the company, will start vesting their shares the second we put, revesting maybe their shares, the second we put our money in. So you don't get a lot of credit in Silicon Valley, or where we call ourselves here, for Silicon Beach, for the idea. It's about execution. So you gotta be in it for the length of time that we're putting our capital in, typically 4 years, sometimes maybe you get 6 months, acceleration, but for the most part, you're in it for 4 years at least to get your full equity. Number two, we have the right to fire you the day we put the money in. We put money in and fire you, you get none of that equity. So that seems kind of odd, but I can tell you, if we did that, we would not be on this panel. We wouldn't be around, right? Of the 95 founders, 93 are still there as CEOs in our companies, or failed or been sold. So the reason I say that is, up front, the founder's equity starts to vest. When the founder issue comes up, it's usually the first 6 months, because everyone's like arm in arm, they're raising capital. It's like, damn, these VCs are hard, Drew sucks, and whatever. It's like, they may say, well, Rick sucks. It's like, but then they raise the capital, and they like, no, we're in this together, we're all equal. One third, we're all doing the same amount of work, whatever. And then within 6 months, it's like, whoa, he's not pulling his load, or she's not, it's not showing up for work, or whatever. That's when it hits. And if you don't have the founding concept in there, then someone's going to walk out the door that has 15 to 20, 30% of the company, and that doesn't work for anyone. So I guess to get back to it, the first thing is make sure there's founder vesting in there. I know you don't think you need it. I know you don't think you're going to have an argument with the co-founder, but it just happens. It happens, I wouldn't say a lot. I've probably seen it maybe, big issues 5 times in the last 10 years, but when it happens, it's a big deal and will absolutely kill the company if you don't have a way to deal with it. So, getting it, I'll let other people talk about softer stuff, but that's the infrastructure of what you typically need, and we always require founder vesting.
And also, I would say, just to get clear on the question, are we talking about the founders among co-founders conflict, or founders with investor conflict, or both? Okay,
let's go with.
I'm sorry if that was the other.
No, it's fine. I think the question is intended for co-founder conflict, but even in general, I think that's a good caveat. Major.
Yeah. So first, totally agree with Rick. I think the fundamental documents-wise, the legal-wise, you have to set up all right, all clear, vestings, all that stuff, find a good attorney, all that stuff. But I think also figure out why that happens is something I would always do, just to talk founder individually and on the board, whatever, right? Just figure out why this conflict exists, right? 'Cause there's always a why, right? Whether it's equity distribution is not fair, or some people are not working, or it's just the culture that it's not a fit. I mean, there has to be a lot of reasons for conflict among co-founders, right? So I would say open up the conversation very honestly, like brutally honest. It's very important for this whole situation, and really talk through it. Right? Sometimes it's okay to let co-founders go. I think we all saw like co-founders, even CEO laugh, all that stuff, right? So it's totally okay with co-founders breaking up. Right, so it just to figure out what's the reason and figure out what's the best solution. But that's really hard to have a general solution. Right? It depends on what the situation is. But the core prerequisite of solving the problem is to be honest to everybody and not hide anything. Be completely transparent to all your co-founders, all your investors on the board room. Like don't just hide things on board meetings and I'm only talking to this co-founder about this situation I'm having on board meeting, and I will hide the information to my other co-founders, right? So that's typically not a good way to run a business, and you'll see a lot of conflict. That's the way to do business, but I would say open up and be honest.
I can build on what does it really mean to be honest, because co-founders is a lot like a marriage, right? And frequently that conflict is not something that just surfaced yesterday. It is built on years and years of tiny resentments. You did this, you did that, and you never properly resolved it along the way, such that now you're at this big impasse. I think it's super important, especially if you're working with a VC, and/or yourself and your co-founders, really look for what are the potential seeds of resentment and really try to nip them in the bud. I'm a bigger fan of prevention, over pound and cure kind of thing, because you can see it. And it's also one of those things where there may also be very legit just circumstance situations, right? Like I went through a period of my life where my parents were severely ill and I was the one paying for it, blah, blah, blah. So that had additional stressors. I wasn't able to contribute as much during that time, right? But the good news is I'd already established a good set, track record and reputation for having been a big contributor up until that point that, my teammates were understanding enough and they were able to let me go deal with whatever it was that I needed to deal with. Now that said, I was also very straightforward with them. And open about it. And I think, we have to think or, ask ourselves, both as founders and as venture capitalists, to what degree are you willing to be vulnerable to your teammates? How much of that are you guys willing to show along the way? Because I think that contributes a lot towards preventing co-founder conflicts and blow-ups. And divorces, for that matter.
So I was raising money for a business with my brother, and 100% of people ask me, so how do you guys get along? Like two brothers, like what, you guys get in fights and in the office, or like what is that dynamic like? And so I always think it's great to just ask people like, hey, if something happens between the two of you, what happens? How do you handle it? Because it could happen. What are the steps that you take? And it's really interesting to listen to what folks say. If someone was to ask me and my brother, hey, if you guys don't get along anymore, what happens? And I'm like, I'll just take a step back and give my equity to my brother, and that's kind of how it'll, if we ended up disagreeing, we'll fill that vacancy, right? Unemotionally figure it out, right? So it's like we had an answer for that question, and that's not maybe the best answer for every single founder, but it's just be honest. What happens if things don't work out? How do you handle it? And even how do you handle small disagreements? It's this ad copy versus that ad copy, or this email or another. Like, how do you resolve conflict potentially between the leaders, and who is the supreme leader here? Like, who is the one that is really driving this to the end result that we want to see? So just expectation setting can go a long way.
Yeah, I really have to just echo the last two from Drew and Christine, but it comes down to preventing situations and hopefully catching them before it really becomes an issue, and sort of thinking through what does that worst case scenario look like. And then just kind of really keeping that open line of communication. And, as us as investors, we've listened to dozens of stories from founders of, daily frustrations and kind of like team struggles, but it's really just kind of, lending an effective ear, but then also really kind of giving that feedback and making sure that everyone's situation is self-aware and is respectful of everyone else's boundaries on the team.
That's right, and I mean, I've seen early co-founders leave a business, sue the founders, say that they were entitled more, say all these things, and like you can't predict when these things happen, and so it's just super important to have things tracked in email, like agreements, even agreements that are they're just written down somewhere, and you can point to and have some expectations. A lot of it's just writing it down too. And just understanding that these are things that could possibly happen.
Great. And so with the last minute here, very quickly, what is the best way for any founders in the audience who are looking to connect with you guys? What is the best way for them to do so?
Find me on LinkedIn. I'm there. I'll accept it. Send me a deck. I'll talk to you.
I would say not at a conference after a panel.
That especially.
That's all my son's a sophomore at Notre Dame. I have to go see him right after this. But Rick at CrossCut.vc is a great way to reach me, and just mention that you were in the audience today. And I want to be supportive and thankful for our sponsors, Quake, and everyone else here. But I unfortunately won't be able to stick around a whole lot today.
Very similar. yp@embark.vc is my email, or also LinkedIn. But I would say I always prefer to refer by non-founder or VC that knows me already. So it's always a better way to get connected to. So I don't have a 100% response rate to cold emails. I try to do like 90%, but we'll see. So.
A great question, because email from me is best. See Harada at ixinvest.com. It should be available on the website. I get a ton of random LinkedIn requests from a lot of people that I'm like, I'm not sure about this. So email is likely the best way to do it for me.
What's your response rate to cold emails?
Very low.
Mucker's is like 95% if any of you guys want to do that.
And very similar for me, it's just danny@atomfactory.com, so feel free to hit me there or on LinkedIn, or yeah.
Awesome, great. Well, let's get a round of applause for our panelists.